Breaking news, we have era of free mortgages over in Japan with central bank raising interest rate. This is really bad for the global economy because now you're having a liquidity problem. We also have an issue that we might see back in 2008. Let me show you guys. So, here, took a little screenshot here of the current interest rate for the Japan 10-year yield. This is at 1.949% when I took the screenshot. This is us right now. This next one is 2007, around the same height. These gray candles are candles that go down, by the way, just in case you need a key of my charting. But you can see we're roughly at the top where we were. This is the top. It's right here and it goes across to this bottom. So it's in the general area where it was back in 2007. You can also see back in 2007 after it hit this high, it decided to crash. We all know what happened in 2008, right? It was great. Onwards and forwards, we have how will a rise in Japanese interest rates affect global markets? Well, as I just told you, you're going to have global liquidity problems. So you won't have liquidity out in the global market, you won't have lending, you won't have banks being secure anymore. I can also tell you what hedge funds did when the rates were at zero. So, this is the situation. You have a friend who is lending you money for almost 0% interest. It's basically free money. And then you go out and you see the US T bills are paying you 5%. So, what you did was take the money from the Japan, and then since it was basically interest free, maybe a little bit, you went and bought a T bill from the US that was paying 5%. So you got that 5% at basically free money, essentially. That is what happened back when it was at zero. So, in summary, it's just borrow cheap in one place, earn high interest rate in another place, and then you keep the extra. This is what's called the yen carry trade. I just simplified it for you guys because I know your guys' time is very valuable and you guys have low attention spans. Onwards, we have bank tap Fed standing repo facility in record numbers amid month end pressures. So this article came out October 31st. I know a little outdated, don't blame me too much, but as we just reviewed, you have Japan's rates going up. They were going up in October too. So, no more liquidity. Banks, they're having problems now because now they're losing liquidity. And if you guys don't know, big banks, they borrow from each other to keep the liquidity going. So here's a simple sixth grade level explanation of interbank lending and liquidity risk. So you have two banks, or you can say you and I. I give you money because I know you're going to pay me back because we trust each other. But if I think you're not going to pay me back by tomorrow, then I am not going to lend you anything. So when banks, us, refuse to lend, even though you're not broke and I'm not broke, but I won't lend to you and you won't lend to me, we start having a liquidity problem because now money's not moving around because money's just debt. So this creates a credit freeze. So then we turn over to the central bank, the Fed, and we ask for emergency money, which is what the bank will provide. But that is only if we have collateral, which is collateral in a debt based system is just T bills. So, big summary, I lend to you, you lend to me, we trust each other, we don't trust each other, no more lending. We go to the big guy in the corner over there that's in charge of everything. He lends to us only if we have something as collateral, which is treasury bills. And now you guys might be saying, stock market went up today. I noticed that. We'll go take a look right now. So here is your S&P 500. We have our head and shoulders pattern drawn out, but we did break upwards. So we do have, let me zoom in real quick just for you, right here. So we broke above the bottom blue line, which was resistance. Now it's support. If we break back down through it, it's resistance again. It also means that we're going to keep falling through floors. That's not very fun. But you have this new blue line that is on top now. This is the high of the previous high. So you guys can't be saying, or I can't be saying, we're in a bull market because we have to break this upper blue line in order to be up. So we have that. Also, we have the Fed talking next week. That will be fun. There's also some divergences, which one goes down, one goes up, and usually the one that went up follows the one that goes down. Yeah, I probably lost you just now, but that just means that we're gonna go down. Happened in the smaller time frames on the S&P 500, so we may see a pullback. But I said that before. Looks like I was wrong. And this week, institutions weren't really trading because big hedge funds, they like to pull their money out before big news comes out so they don't get hurt. Anyways, the solution to fixing your problems is, well, now that window's closed, so hedge funds, you guys can't be doing that fun little Japan yen thing anymore where you do the yen transfer trade, get that free money. Um, your T-bills, they're pretty high still for the US. Japan, we're up on the 10-year T-bill, which means we don't have debt flying out now, which means global liquidity is going down. And the solution to all of this is go ahead and start a business, start raking in some money so you can afford those bills and all that expensive food. And I will see you guys next week.